If you're a small business owner or a sole trader, there's a good chance you're doing at least 3 things right now that could trigger ATO audit. And the worst part, you probably don't even know you're doing them. I'm Davie Mach, a chartered accountant, and after working with hundreds of businesses over the years, I've seen the same patterns over and over again. The businesses that get audited aren't necessarily the ones doing anything dodgy. They're often just the ones making predictable mistakes. Today, I'm going to show you the biggest audit triggers, and more importantly, exactly what you need to do to stay out of the ATO's radar. Let me start by saying the ATO's audits aren't random. They use sophisticated data matching and analytics to identify businesses that look suspicious. And with that extra $1 billion in funding this financial year, they're getting even better at this. The ATO has access to data from banks, payment platforms, crypto exchanges, property transactions, insurance companies, and even your social media. They're cross-checking with everything against what you've reported. So if there is a mismatch between your lifestyle and your declared income, or if your business metrics look unusual compared to similar businesses, you're going to get their attention. Since July 2019, the ATO has received over 250,000 tip-offs about tax avoidance and other dishonest behaviors. They actually receive almost 1,000 tip-offs every single week, and about 90% of these are analysed and deemed to require further review or audit by the ATO. I can't say for certain how many audits are a result of these tip-offs, but being an accountant for over 18 years tells me that this can be a big factor in why you've been chosen as an audit. With that said, let me walk you through the 6 most common things that triggers an audit. Because once you know what they're looking for, you can avoid these traps. Number 1, late or missing lodgements. This is a big one. The ATO explicitly warns that avoiding or delaying lodgements will attract our attention. If you're consistently late with your tax returns or business activity statements, you're basically sending a red flag straight to the ATO. Even if your cash flow issues are causing you problems, it's better to lodge on time and work out a payment plan than lodge late. The ATO sees late lodgement as a sign of poor record keeping and potential non-compliance. Number 2, unreported or mismatched income. As I've already mentioned, the ATO's data matching systems are incredibly sophisticated. They cross-check your reported income against information from the banks, employers, payment platforms, and other sources. If you're earning money through gig economy platforms like Uber or Airbnb or cryptocurrency trading, or even side freelance work, the ATO probably already has that data matched. Forgetting to declare this income is one of the most common audit triggers. Number 3, inflated or unusual deductions. This is where a lot of business owners get into trouble. The ATO analyzes industry averages and compares your deductions to similar businesses. If you're claiming much higher deductions than what's normal for your type of business, you're going to attract scrutiny. The classic mistakes I see are claiming 100% of your car as business expenses when you clearly use it personally, writing off family holidays as business travel, and claiming your entire home internet and phone bills as business expenses. The rule is simple. If you can't prove it's genuinely business related, don't claim it. Number 4, consistent losses. It's normal for a startup to make a loss in first year or 2. But if you're reporting losses year after year, the ATO will start questioning whether you are running a genuine business or just a hobby designed to claim tax deductions. The ATO generally views 3 loss years out of the 5 as a pattern that indicates a red flag. If you're consistently in the red, you need to be able to demonstrate that you're genuinely trying to make a profit. Number 5, cash-heavy businesses. If your business operates largely in cash, you're automatically in a high-risk category. The ATO closely watches industries where cash sales are common, like hospitality, trades, beauty salons, and retail shops. They might compare your reported sales against industry benchmarks or even check your suppliers' records to estimate if cash might be missing. If you accept cash payments, you need to be diligent about recording every transaction. And number 6, out-of-line industry performance. As I've already mentioned, the ATO uses small business benchmarks as a health check. So they compare your financial ratios like cost of goods sold, profit margins, and expense percentages against others in your industry. If your numbers are way outside the normal range, it suggests that something might be wrong. For example, if most cafe businesses spend 30% of turnover on wages and you claim 60%, they're gonna take a closer look. You can check out the ATO small business benchmarks here. So, how do you stay off their radar? Your first line of defense is maintaining detailed financial records of all income and expenses. Keep invoices, keep receipts, bank statements, and logbooks for any vehicle or home office use. The law requires you to keep these records for at least 5 years, but more importantly, you need to be able to quickly produce evidence for every figure on your tax return. Then make sure every dollar of your income is accounted for. This includes cash sales, online earnings, freelance work, cryptocurrency profits, and sharing economy income. Everything. Thanks to their data matching, the ATO can see most of these income streams anyway. The third thing you can do is before claiming any expenses, ask yourself if it's truly business related and if you have proper evidence to support it. Be particularly careful with vehicle expenses, home office expenses, travel expenses, and entertainment. Next, make sure you consistently meet all lodgement deadlines. Set reminders or use a tax agent who can get extended deadlines. Even if you can't pay immediately, still lodge on time and arrange a payment plan. Another thing you can do is get familiar with the typical financial ratios in your industry. The ATO publishes small business benchmarks. Use these as a guide. If you're a significant outlier, make sure you can explain why. If you operate cash-heavy business, implement strong controls. Use cash registers that provide daily totals. Bank your cash regularly and never keep 2 sets of books. Always issue receipts and maintain a complete transparency in your record keeping. And lastly, make sure you're meeting all your tax obligations. Don't forget about GST, superannuation, PAYG withholding, and other requirements. A lot of the audits start with one issue and expand when they find other problems. Pay your employees super on time. With modern reporting, the ATO is immediately alerted to unpaid super, and it's a common trigger for broader audits. If the ATO does contact you, don't panic. Often they just want clarification or additional information. Respond promptly and honestly and get professional help if needed. The worst thing you can do is ignore their correspondence. That's when simple queries turn into full-blown audits. Look, the reality is that the ATO audits are becoming more common and more sophisticated. But if you're doing the right thing, keeping proper records, and following these guidelines, you shouldn't have anything to worry about. The key is being proactive rather than reactive. Don't wait until you get that letter from the ATO to sort out your compliance. I'll see you guys next time.